Swaps. So in this session, we briefly discuss currency swap and interest rate swap. So first, currency swap. Currency swap. So it's an exchange of cash flow in one currency with that of another and is made possible by currency swap. There are three different types of currency swap: principal only swap, coupon only swap, and principal plus interest or P plus I. So first let us see what is currency swap. An exchange of cash flow in one currency with that of another is made possible by currency swap. Here the lender eliminates currency risk when the cash flow relates to repayment of principal or interest or both under a loan obligation. There are two or three possibilities. If only currency is hedged, it becomes principal only swap. So if the currency is hedged, it becomes principal only swap. If interest rate is hedged, it becomes coupon only swap. Also, both the items can be hedged together or separately and is mostly left to the likes of the client on how they want to do the mechanism. So that is what is about currency swap. Now, currency swap, need for currency swap. So the need arises whenever a client faces currency mismatch. For example, if a loan taken by a company is denominated in one currency and the revenues that get accrued for the same company is in another currency, there is currency mismatch. The example you have to basically take into consideration here, what we are telling is, if a loan taken by a company is denominated in one currency and the revenues that get accrued for the same company is in another currency, there is a currency mismatch. So the need for currency swap arises whenever a client faces currency mismatch. We'll try to illustrate this. So here we are imagining that there are two firms. One firm in Germany who wants to invest in India needs India funds. Now there is another firm in India who wants to take over a firm in Germany, needs Euro funds. So how they typically go about with this and where currency swap can be helpful. So for a hypothetical case, let us consider that a firm in Germany intends to invest in the Indian market and hence is in need of rupee funds. During the same time, let us imagine that a firm in India which is well rated needs Euro funds to take over a company in Germany. So from their mode of operation, it is further imagined that the German investor is in a strong position to raise Euro funds at relatively low rate. So what he does is he mops Euro funds since they can do it domestically. The position also is reversed when the Indian firm or company with a good domestic rating is in a good position to raise rupee fund at a lower rate. So the Indian fund goes ahead with mopping India funds in rupees as they have a good rating in India. Similarly, in Germany, the German firm goes ahead and mops Euro funds since they can do it domestically. Now, it is then hereby good logic to imagine the two parties raise loans in domestic currencies and swap the loans to serve their individual objective. However, for the two parties to do exactly that, there should be a matching demand. So who does that matching demand? It is basically the bank who will be the financial intermediary who will do the matching between the clients who are in two different places, one in Germany and one in India. The matching is done by bank and who acts as the financial intermediary. So this is where bank plays a pivotal role since they act as financial intermediary and is well placed to offer currency swaps to the interested clientele, that too without having to wait for the matching demand. So that is how the currency swap works. Now the demand for swap is driven by borrowers. We know that usually the interest rate advantage of domestic company is the main reason why there is a demand for currency swap. But recently, money lenders or borrowers also enter into swap to derive the benefit of interest rate arbitrage. Many Indian companies raise ECB or external commercial borrowing in USD, Euro or JPY and swap them to regular Indian rupee loan. The cost for this, which is the swap cost, represents interest rate differential of currencies, as there exists no arbitrage between major currencies. This is also because swap is a series of FRA, forward rate agreement or forward exchange contracts, currency forwards. Please see the section on currency forward to understand how it works and what it means. Okay, so this is also because swap is a series of forward exchange contracts or currency forwards, and the FRAs or interest rate forwards corresponding to the payment dates. Net benefits. Net interest benefit exists only when there is a difference in credit spread or a spread that exists of the borrower in two currencies over risk-free 6M, LIBOR, etc. So that we have gone briefly into the currency swap. Next, we'll consider what is interest rate swap. Now, interest rate swap. Interest rate swap is an exchange of interest flows, the value of which is the notional amount of swap, and the interest flows on underlying assets or liabilities. According to the requirement of the borrower or lender, the calculation of interest is changed. To illustrate interest rate swap, let us imagine a company paying fixed rate of interest at 7% on its 5-year debenture. So that is the current situation. A company pays 7% interest to the debenture holders on 5-year debenture, which is a fixed interest rate. Now, the company would like to take advantage of the market because the interest rate is declining or falling. So how the company can do it? With the help of interest rate swap. So in the market, let us assume the market rate of interest rate is declining. So that is why the company wants to take advantage of the falling interest rate. So it makes sense for the company to enter into a interest rate swap with their bankers, exchanging fixed rate with floating rate with a 3-month treasury bill rate as the benchmark rate. So 3-month treasury bill the company is counting on from the bank, which is at 5% floating rate now as we speak. So in order to match, the bank, what it does is the bank has to match 7% interest. Bank has 5% floating rate T-bill, so it adds 2% credit premium and it matches that in the current situation. So if the swap rate for this treasury bill is 5%, or in other words, the floating rate is 5%, what gets swapped with fixed rate is floating rate interest of treasury bill plus 2%. That is the current scenario. So bank matches 5% floating rate treasury bill plus 2% credit premium, which works out to 7% fixed interest. So bank pays 7% fixed interest to the company. Company pays 5% floating rate on a treasury bill, which is 3 months duration, plus 2% credit premium. Now here is where it gets tricky. After 1 month, if the market rate of interest for treasury bill reduces to 4%, company pays only 6% to the bank and bank still pays 7% to the company. Why it's 6%? Because the treasury bill interest has also gone down because it is a reflection on the market rate. It has gone down to 4%. So it is 6% only which the company has to pay the bank, and bank still pays 7% interest on 5-year debenture, which the company promises. So it pays 7% interest. That is what is it. So the company saves it. So that would mean the bank pays the company interest rate at 7%. Now, suppose the interest of the treasury bill reduces to 4%, we know that the company is at an advantage. Company needs to pay only 1% less. So for the treasury bill, it is a risk-free instrument issued by the government of India and is accepted benchmark for pricing corporate debt instruments. So in this illustration, treasury bill rate, by which what we mean is the risk-free market rate plus 2%, which is the credit premium added, equal the fixed rate of 7% that the company pays for its 5-year debenture to its debenture holders. So as and when the treasury bill rate reduces because of a fall in interest rate in the market, the company benefits. If it becomes 3%, 2%, accordingly the total interest which the company has to pay to the bank reduces. Bank will still pay 7% interest on 7% interest, which is fixed interest to the company. So this is how an interest rate swap works. So this concludes a session on swap, where we explained currency swap as well as interest rate swap. Thanks.